Hey guys, welcome back to the Capital Mindset Show. Today we got three different stocks to talk about. We're going to analyze basically all three, kind of a preliminary analysis on each of them. We're not going to be going over the earnings report. It's just too much content, guys. All right, so trying to cover everything. I'm going to start from now on. You guys might be seeing the Voyager Digital one. If it's heavily requested that I do the earnings call reaction, I'll do it. Otherwise, I'm going to be delegating it mostly to the stocks that I actually own in the portfolio. Otherwise, it's going to be a little bit too much. I mean, to be honest, if I listen to the earnings report, I'll just record myself, and that's how I'll do it, because I do listen to a lot of earnings reports. So if I'm listening to an earnings report, I'll record it and I'll post it. It might get it might get spammy, but I know that's bad for the YouTube algorithm, but I don't really care. So here we go. We're going to do Walmart, Target, and Costco here today. We're going to start off with Walmart, and Walmart is going to be down 6.27%. You guys see the market's actually getting absolutely annihilated up above with, the Dow Jones, S&P, NASDAQ, Russell all going down. VIX is actually even up higher than the previous video that I just recorded. Now, Walmart here, you might notice in my portfolio, I don't hold any retail stocks. There's a particular reason. I will start by dispelling one particular myth about these companies, and it is that these guys are massively profitable companies. This is big business, this is scary business, etc. Well, the truth or the matter of fact is Walmart's margins, and you might be seeing this more often now than not, but this is something I've said previously in the past tons of times. Walmart has terrible margins. Walmart's margins are a little tiny amount. Same with Target, right? In fact, retail has very slim margins. Very little room for error, because all of the costs on these discount retailers, which Target is a discount retailer, by the way, believe it or not, is passed on to the consumer. So, for example, Target, in a lot of instances, actually does have cheaper products than a lot of other stores. Walmart has by far the cheapest than other stores. Not the complete cheapest, but they all compete against one another for cheaper and cheaper products. Now, why it is that they do that? Well, they're trying to pass on the savings to you so that you come to them, and they're willing to decrease their margins so that they get more volume. And through that volume, they get a larger nominal amount of income. Now, with that being said, that does leave less room for error, so they are susceptible to inflation if, put an asterisk around that if they're not able to pass on the cost to the consumer. So then they have a couple choices, and they have to do this. And revenue can go up and continue to go up, and earnings might still take a hit, because inflation, they might be increasing the price, but not to the same degree as it's costing them to acquire the goods and services that they're offering. Okay, so we have to understand that. And I do think over the next couple of years, we might see actually potentially some increases in revenue while declining profits at the same time, or declining margins at the very least. Because inflation is not a problem as long as you can increase the costs to your consumer while remaining competitive, because you have to remember that this is a very dynamic space while you're increasing price. If your competitor isn't increasing that much price and they're willing to take slightly more of a hit, they might get more customers. So it's very cutthroat. It's very cutthroat. And scale matters. Something like Walmart has a tremendous amount of scale. So the only retailer I do have one retailer is Amazon. But Amazon, I hold it because it has a loss leader, so it doesn't necessarily care too much. Now, I've already talked about why I trimmed down the Amazon position in the past, and why I do look forward to, and I'm watching it closely, to add to my Amazon position in the future at a good price. But I kept it at where it is now in the portfolio, according to its size. So something like Walmart doesn't have that ability, unlike Amazon, and Amazon will continue to actually grow and scale and surpass Walmart in terms of online retail sales, in totality of retail sales. So Walmart used to be the big behemoth in terms of sales. Now they are not. And by the way, I've seen videos in the past comparing Walmart to Amazon. It's hilarious, because it just basically it's someone that doesn't understand what Amazon is. And so, or why Amazon is so dangerous to something like Walmart. Walmart doesn't have Walmart Web Services. If they had Walmart Web Services and it was very competitive to Amazon, then I'd be okay, well, Walmart's similar. Walmart is a good retailer. It's very good at achieving low prices for its customers, but it doesn't have these other businesses that make it just a screaming buy. Now, Walmart Plus is interesting, I'll say that, because with Walmart, you can get that Plus package, and that is in essence a direct to the bottom line for the company, something like akin to Amazon Prime or Costco, which we'll get to Costco, but for the most part, most customers of Walmart are not subscribed to Walmart Plus. Okay, so again, if we take the 5-day decline, we do see it is down 17.87%, so nearly 20% of its market cap gone, and we'll take a look at Target when we get there. But I will go over the earnings presentation for Walmart first. This is the sales pitch. Again, this is what they're trying to show as the highlights of the good stuff. Some people invest entirely just on this. I think that's a big mistake, but this is kind of getting to the idea of if we don't like what we see in here, we're not really going to like anywhere else. And that's a simplistic view, I know, but it's good enough for the purposes of this topic. Now, taking a look at total revenue, do you see that? Revenue grew, net sales grew. However, what happened to income? Okay, and this is where I'm trying to tell you guys, please do not make that mistake. It's the wrong type of analysis. Do not say that revenue will go down or maybe decline in an inflationary environment. No, no, no. It will go up. In nominal terms, it will go up. What will get squeezed is the income. Income will get hit hard, okay? Because the income might reflect the declining margins because they're not able to pass on all of those expenses to the consumer. And as you know, we've on this channel been talking about the liquidity crunch for quite some time. I know I'm repeating myself a lot on that, but again, it pertains to this. We've been talking about how the consumer is getting squeezed on multiple fronts, from the expenses of oil, expenses of food. These are necessities. If these start to, if the consumer gets squeezed on those other fronts, which we've again talked about in many videos at this point, then you will see the discretionary income or discretionary spending, will come down. And who is affected by that discretionary spending? Well, look no further than Walmart. Look no further than Target. Look at these companies that primarily drive most of their sales still from these other services, right? Or these other products. And so, of course, this is happening, okay? Now, their effective tax rate is 27.5, which is interesting because it is above. But again, they're in multiple jurisdictions, and there's a lot of nuances effective to that. Adjusted effective tax rate, we don't really care about that. Okay, so we don't really care about any of that stuff. I just want to highlight the gross profit is down by nearly 1%. The operating income is down 23%. The net sales, okay, all that is still going up. And people are like, well, revenue is going to go down. No, inflation, they're going to raise prices, but they're not going to raise prices equivalent to that of the costs. Okay, and that's showing in the margins. The margins are showing that. Okay, so, but sales can decline if we see a overall drawdown in the overall economy. That can in fact happen because you have to pay attention to what it is that they do sell. So they might see growth in grocery, but not growth in, let's say, other products that people don't really need because people are going to focus on more what they need. And then if wages, because remember the discussions about inflation, I think like last year, wages are a lagging indicator to inflation, or they're not a lagging, they're a lagging reactor to inflation. So, and that's why when people say inflation, I've seen articles, inflation is good for the working class. That's really ridiculous. But regardless, we're not getting into that. All right, so receivables, all this stuff's going up, and people are like, what's going on? Inventory is going up. Okay, that's the value of inventories. So the value of inventories is going up by 32%. Accounts payable. In the earnings call, if you listen to the earnings call, what the themes that I want to address, because I won't play the earnings call here, is inflation, supply chains, and yes, and labor costs. So labor costs coming up. They barely have a margin to work with. So any changes in those cost structures will affect drastically the performance. Now, where I think they have room to improve is in the labor category. There's a lot of efficiencies that they can achieve in that category, as well as the distribution channels, a lot of automation. Well, that kind of connects with labor, but regardless, there's the share repurchases, I think, were terrible, stupid. I'm sorry for using that word, but very stupid. I think that they were doing it at a misopportune time. That was money that they were just burning. And for those of you who are buyback onlyists, I'm sorry, but you're wrong because buybacks are very bad if they're executed poorly. There's plenty of examples in which we can draw upon that show when buybacks are executed poorly, they're terrible, okay? Because they're literally destroying shareholder value. Share repurchases at the prices they were at was an absolute destruction of shareholder value. Okay, I don't care what this number is. Shareholder returns of $4. No. You took that 2.4, okay, and I think that's in billions or whatever. Yes, in billions. You took $2.4 billion and you burned it. That's what you did. You should have taken that $2.4 billion and been investing in the business, investing in improving efficiencies across the board. Or maybe just giving it as cash to dividends, right? As dividends. But definitely as maybe like a one-time special dividend. Definitely buying back shares. Hindsight, who could have predicted that, was a terrible decision. Absolutely garbage decision to do. All right. So bad on management. That's already a red flag that management is not allocating capital the way I would like, which already kind of X's it out for me. So yeah, let's take a look down here. Net sales, okay, cool, whatever. Gross profit rate, whatever, don't really care because we already talked about that. Okay, here we go. So groceries, low double digits. Who would have figured? All right. Health and wellness, high single digits. Who would have figured? This is where I was talking about, right here. Boom, general merchandise is down. Okay, softest discretionary categories. Ooh, who would have been talking about discretionary categories potentially getting hurt because the consumer's probably going to get squeezed? Oh no, totally not talked about ever, right? Yeah, cool. All right, so Walmex, net sales growth, China, Canada. Oh, okay, whatever. Walmex with fuel, e-commerce sales. Okay, e-commerce sales, net sales grew. Okay, cool. But the point is, sales can grow and profits can go down because sales don't pay the shareholders. They can pay the bills, but they don't pay the shareholders. And they're not growing as fast as the costs. Okay. Now, this can change. I think if things get, the biggest cure to all this is if things get really that squeezed, it draws down demand drastically. And we'll have a more severe pull down or downturn in terms of a recession that can bring down some costs. But like I've been stating, if you maybe I should do another macro video on like QE and stuff. I know that some of you have been asking for me, but there's just so much other stocks, I guess, to talk about that sometimes I get carried away. We can probably talk about it in the live stream tonight. But let's actually take a look, I guess, now at Target. So Target stock, we'll actually bring it up here. So Target is down 27.38%. They don't have a presentation at the present moment, but I'll talk about their earnings call. So basically, the CEO is talking about exactly the same things as Walmart. They had labor costs rising, supply chain, all the disruptions going on right now. And yeah, it's down. It's losing more than a quarter of its market cap here today. Absolutely incredible. Okay, so what's going on with the Target? Well, exactly the same thing. The majority of their sales don't come from grocery. They come from general merchandise. So surprise, surprise, they're going to get hurt. They're going to get hurt. So something like, let's say a Kroger. Let's pull up Kroger because right here, Kroger. So Kroger is also down 6.82%, but Kroger makes the majority of its money from groceries, something that's not going to get hit as hard as general merchandise, as you saw with Walmart. And if you looked at Targets, it's pretty much the same story. Let's take a look at ACI. So ACI is another company, down 7.15%. This is one we have talked about in the past, no longer involved in this one. But this one is, oh, and there was another one I'm no longer involved with that is my favorite one, but we'll get to that. Well, actually, I'll pull it up right. No one really knows about this stock. I think it was a Michael Burry stock at one point, but I'm no longer involved with this one. This one was more of a sell that happened this year, and it was before I made my portfolio public. I actually sold it in January, early January, December, around here. Yeah, like literally around here. And then I looked stupid because I remember it was around here. So now it actually is lower than what I sold it for. So I look smart now, but regardless, we're not talking about that. The point is grocery stores are going to have less of a problem when they're trying to pass on costs to consumers because they're not part of that discretionary category. And then companies that are selling in that discretionary category, they're going to have a little bit harder time passing on those costs. You're going to see a drawdown in prices. So who would have thought this is from now on for you to understand this? If inflation is going to be a big deal, you want to stay away from companies that are unable to pass on the cost. So really do an analysis on all the companies that you own and think to yourself, can they pass on the cost to the consumer in an inflationary environment? Now, from here on out, we're already now pricing in this inflationary environment. I mean, let's go back to Walmart, right? So Walmart, what was it doing throughout this inflationary environment? It went up, okay? And it did not make sense. The market was not pricing this appropriately. We might have mentioned this here and there in a live stream. I might have mentioned it in Strawman's live stream, but this was a consistent I guess, opinion, you could say, between that whole group, okay? Because even Strongman at the time, when we were definitely on his live stream, he would phrase this as such that Walmart was overvalued. He loved the company and Walmart was overvalued. He was absolutely correct. Now, the intricacy of the argument we can kind of point to as being you do not want to own a business that primarily drives its profits from discretionary spending. That is silly. That does not make sense. Okay. So something like Walmart has a massive grocery business, but it's not enough to carry the business forward as the discretionary can. Okay. And again, Walmart doesn't have something like an AWS. Now, Amazon, if you checked out the Amazon video, I did state it is overvalued. It was overvalued, and I'm not still buying it yet. And actually, just to pull up Amazon, why not? Because I haven't seen Amazon today. Amazon's down another 7.18%. Okay, congratulations. Because, that video, I guess there were some Amazon people who really like Amazon. They did not like the video. So a couple people were like, nah, boo, thumbs down. But regardless, it is down again today, and we'll probably get those prices again. I'm very confident in the prices that I kind of state, and those are the prices that I'm going to be buying at. Period. Okay, I don't really care what the market says. If the market doesn't give me those prices, I don't cry about it. Okay, so regardless, theme of the story here, discretionary, bad in terms of retail. In terms of necessities, good exposure. Now, everyone's getting thrown out together today. Again, like we took a look at grocery stores, they're getting thrown out because of the broader kind of, you could say this is sympathy sell-off. It's a sympathy sell-off, okay? We're going to actually evaluate Walmart and Costco and Target. Actually, we're going to refrain from evaluating Costco. I'm sorry, I know I promised, but I'm going to evaluate it next week. We're just going to talk about it, but I'll stick to the evaluation next week. So Costco is down 12.87%. The thing I want to separate with Costco is that Costco is a membership-driven business. In fact, the grand majority of their profits come from the memberships. I'm a Costco member, and the actual sales point is just kind of to cover the costs and barely eke out a profit. And that's how it's designed to be. So with Costco, the problem is they were tremendously overvalued. Period. End of story. I mean, just on a simplistic GAAP PE basis, they're 34.4. Just that's a quick glance. They're overvalued. That's incredibly overvalued for this kind of business. You see the recent performance since about 2020. So let's see that. Yeah, about 48% even then, and about 107% for this kind of business that isn't going to be growing all that much. I think it's kind of entering its maturity phase. But you see that the year range, it hit $612 on the high. That's absolutely incredible. So this has to, already off the bat, I can just tell you, it has to pull back even further. But I will tell you, as a business, will not suffer nearly as much as Walmart or the likes of Target from inflation problems. They make the majority of their profits from the actual memberships. They don't really make profits from the actual sales. They do make some, but they don't really care about that. Now, that being said, let's go back to the original point. It leaves very little room for error. If Costco makes a mistake managing their inventory, that mistake can be very drastic, and it will eke into the profits of the memberships. Okay, they will have to swallow those costs. But that being said, if they maintain that well, okay, then they're going to be able to manage better than something like Walmart or Target that drive the primary amount of profits from their retail sales, okay? So that's hopefully the theme of this. Now, we're taking a look at this. I've already plugged in Walmart just for the sake of it. Walmart, just so everyone understands, and I want to be very clear with this, has a forward P expectation of about 20. Okay, so that's the forward P expectation. They're expected to become more profitable into the future. We're discounting it right now at about a 12%, assuming some degree of buybacks. This is garbage. I hope they shouldn't have been doing that back then. They should be doing that maybe into the future a little bit. Not really at risk of bankruptcy. Surprise, surprise. Estimates for sales are actually to decline now into the future, and estimates for the for the cash flows are expected to rise. They're expected to decline this year and then rise next year. So basically kind of fixing up what's going on. Shares outstanding have been declining. So, I consider that they're probably going to continue this policy into the future. Now, these growth rates, completely ignore them. They're not going to be growing at those rates. And in fact, I think that on a high point, they can grow on a high point. And we're going to actually put these probabilities as a yes for the custom weighting. On a high point, I penciled out about 10%, 12%, and on a low point or midpoint, they're going to grow at, to be honest, 5 and below. Yeah, 5, 4, and last one, 2%. Long-term growth of U.S. GDP, to be honest. if we're being honest there. So that's the evaluation. Now we can kind of see what the market's kind of pricing it for. If you think they're going to grow at around 5 to 10%, the market's kind of expecting an 8% average return rate for this company. 6%, everything's a buy. But that's like no margin of safety. But regardless, for 7%, you're already in the green for what it is that you're looking for. But why it's not worth it. It's really not going to be worth the risk. And I would actually say Walmart still, I'm not touching it, not even interested. I'll be a customer, I'll buy from them, but not really interested. Now let's pull up Target. So give it a second for Target. By the way, according to analysts, it was a strong buy. So just buy it off of analysts. And also, Target's a strong buy because of analysts. So just trust the analyst and you'll be fine. Trust me. They've never steered you wrong. Analysts are infallible. All right, so Target actually is less overvalued than Walmart, believe it or not. Walmart is more overvalued than Target. Target is quite a premium destination, but they are still a discount retail chain, by the way. So with Target, let's put it at the standard 10. Okay, they're buying back a little bit more aggressive than Walmart. That's fine because they were less egregiously overvalued than Walmart. Walmart literally was burning your money, by the way. So that's already I disagree with management's ability to allocate capital. Okay, so sales are good. Cash flow, same thing. Estimates, shares outstanding are declining. So we're going to, at that point, assume a decline of about 2%, a buyback, rate of 2%. And we're going to kind of play around with these growth rates. I think for them, it's going to be very similar. Ignore this growth. This growth is assuming these crazy fluctuations and declines here and there. So ignore that. I would say that on the high end, this one could be. Oh yeah, we have to actually remove this. But no, we're smoothing it out. We're actually smoothing it out. So yeah, we are smoothing it out here. So I'll keep it smoothed out because I think it justifies it. I'll actually remove the quote unquote smoothing out process because I'm basically normalizing them. So no and no, just to see. Again, it's labeled incorrectly, so ignore that, please. Okay, so I'm removing the smoothing out process, so it's not doing that in the background. And if we do that, then you can see that it's not that overvalued, actually. So I was expecting it to be more overvalued. Now, we're going to play around and kind of provide some more pessimistic scenarios, increase our margin of safety here to about 15%. So if we were to do that, then you can see how, it is pretty reasonable if you think a 10% is possible. Now, I'll actually go over and see what analysts are kind of estimating. Analysts are estimating between a 3 to 5%. So 5% is the price point at which I'd say it's actually getting interesting. Because when I did my analysis, I thought that 4 to 5 was the most probable. And so I actually allocated them at the higher probabilities. Of course, I can customize and change these, but I kind of agree with the 60, 15, 15, 8, 2. I think on a 10% probability, they do grow at 10 to 12. That's if they're able to actually pass on these costs to the consumer in nominal terms. In real terms, it will be about the same in terms of profit value. But in nominal terms, it could increase with inflation over time. That's if we basically increase at a higher base rate for what the value of money is. But yes. So that would actually equate to, in nominal terms, of the stock price actually going up, just so you kind of I express that a little bit further. Now, on a forward-looking basis, I want to actually express that the forward PE actually is at a 20. So a little bit declining profitability expected by analysts. So keep that in mind. I would say that, analysts do have this rated as a strong buy. I'd say Target is less egregiously overvalued than Walmart. Walmart is not as overvalued. Sorry, Walmart is way more overvalued than Target. I don't know why, but it is. And I'd say, if you look at the grocery chains, they look cheaper for a reason, though. And if you know what, we're already here. So let's actually kind of throw in ACI. Yeah, ACI. We'll do ACI, and then we'll kind of close off with our closing thoughts here. Let's let it warm up. Boop, boo, do, 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 do. There we go. So strong buy, 97%. Wow, look at you, analyst. Absolutely going nuts with this. All right, so ACI, I remember from the past, is a company that was priced back in the day when we got involved in it on Capital Mindset. If you remember Austin, he got heavily involved in this stock. My wife got involved in this stock, so that's the extent I got involved. We're no longer involved with this one. I was involved with Ingalls personally, and I'm no longer involved with that one either. But yeah, so this one, I think you could discount it actually quite aggressively, and it still was churning out a buy when we got involved. So when we got involved, it's actually below $20, and it was a screaming buy all the way through. Now here today, it's not actually that overvalued. However, you got to kind of tamper your growth rates for this one. So last time I checked for this one, I actually think like the high end is like 5 or 6 to 5, and then 5 underneath, 4. And then I believe that there is a possibility that they do have a small decline because they are trying to shrink their footprint in some instances, trying to slim down the business. And 4%, I'd put a 3%. So on that note, with this company, they are cheaper. They are doing a little bit more buybacks, it seems. Yeah, right here more recently, they are doing a little bit more buybacks, so that's all well and good. I would say that my concerns with this company are their ability to kind of negotiate well with unions. That's a big risk for this company, and maintain a market share in a ever-growing competitive environment. The grocery sector, the only problem with the grocery sector is how competitive it is. Walmart is the largest. Kroger, I think, is number 2, followed by like Target. I think Costco's in there. So this very competitive line of business. A lot of players in this industry. So keep that in mind. All right. On that note, I'm pretty much going to close it off here. So we analyzed 3 different companies. I replaced Costco with ACI. You'll see Costco next week when it reports. And then, we might be able to talk about this on the live stream tonight if you guys want to. But on that note, guys, thank you guys so much for watching. I'll see you guys in the next one. Bye.